Welcome to the Explainer. Look, if you're managing a global energy portfolio right now, I bet your terminal screens are just flashing red with alerts from the Eastern Hemisphere. We've got massive disruptions in the Middle East, serious volatility in the Strait of Hormuz, war risk insurance premiums going through the roof, and shadow fleets moving barrels completely off the books. So it's totally natural and frankly expected that you'd price your geopolitical risk premiums based on the stability of those maritime choke points. But what if we need to look a little closer to home? So I want to kick things off by asking you to totally rethink your baseline assumptions for a second. Where is the absolute biggest, most underpriced threat to the North American energy market right now? Because if you answered the Middle East, you are missing a massive tectonic shift happening right under our noses. The brutal truth? It's actually Alberta, Canada. Yeah, Canada. For decades, retail investors and institutional analysts have basically treated North American oil like this stable, unified monolith. The assumption has always been, hey, it's close to the US, they're in the G7, the infrastructure is perfectly secure. But as of mid-2026, that assumption is a really dangerous illusion. There is a grassroots movement aggressively pushing to trap billions of dollars in landlocked assets through a political divorce. In this explainer, we're going to unpack this hidden alpha across 5 areas. 1. The 300,000 signature catalyst. 2. Pricing the Separatist Premium. 3. Pipelines as political landmines. 4. The First Nations firewall. And 5. Strategic implications. Let's get right into it. Section 1. The 300,000 signature catalyst. We've got to start with the actual data that shifted this whole thing from a fringe internet debate into a full-blown constitutional crisis. This is all being driven by the Stay Free Alberta movement, an organization pushing back super hard against federal green initiatives that many folks in the province feel are explicitly designed to choke out their oil and gas sector. Just look at this single, glaring number, 301,620. Back on May 4, 2026, the leader of Stay Free Alberta, Mitch Sylvester, literally rolled up to Elections Alberta in a convoy of 7 trucks to drop off these signatures. To put that into perspective, the legal requirement to force a citizen-led secession referendum is 178,000. They gathered 170% of the required threshold. That means roughly 1 in 10 adults in the entire province signed a document demanding a vote to become an independent state. The organizers were literally calling it their Stanley Cup final. And the timeline shows you exactly why the clock is ticking. The signatures were collected between January and May. If they're verified, this question hits the actual ballot on October 19, 2026. But of course, it's not going smoothly. Right now, the verification process is stuck in this massive political interference crisis. Elections Alberta and the RCMP are actively investigating a major data breach where a separatist-linked group allegedly grabbed a list of almost 3 million Alberta electors and shared it with the Republican Party of Alberta. Authorities are actively scanning the petition for seeded names from this hack, so the drama is incredibly high and the stakes are even higher. Section 2. Pricing the Separatist Premium. The big question is, how does this political theater actually translate into financial reality? Because make no mistake, this instability is actively bleeding into commodity price spreads right now. So let's define what we're looking at here. Enter the Separatist Premium. This is not your standard discount based on crude quality or pipeline congestion. This premium is the market's real-time assessment of the probability that Alberta's vast oil sands could end up completely politically isolated. Think of it like this. It's like buying a heavily discounted house, knowing there's a 50% chance the divorcing spouse is going to legally seize the only driveway leading up to it. Real constitutional instability is now being priced directly into Western Canadian Select. Let's look at the hard data from March 2026. West Texas Intermediate, the U.S. benchmark, was soaring at $91.38 a barrel, mostly driven by all those intense risks in the Middle East and the closure of the Strait of Hormuz. Now, under normal conditions, Alberta producers would be printing money right now, but Western Canadian Select, or WCS, only averaged $75.85. That created this massive implied differential of $15.53. As analysts pointed out, WTI is flying high on Iran-related risk, but WCS is just kind of along for the ride, totally weighed down by its own localized geopolitical anchor. And honestly, it got worse. By early May 2026, the SPAT discount widened to $16.65 per barrel. It actually jumped by $1.50 in just one single week. What we're witnessing is a severe wait-and-see backwardation in the market. Traders are basically saying, sure, we'll pay for barrels today, but the back end of the futures curve, we are heavily discounting long-term stability in Canada. Add to that the U.S. releasing oil from its strategic reserves to counter Middle East pressures, which just further suppressed heavy crude prices, and you've got an absolute perfect storm for the WCS spread. Section 3, pipelines as political landmines. So why is the market this spooked? Well, we have to look below the surface of the pricing models and examine the physical infrastructure, where pipelines literally turn into political landmines. Let's talk about Team EP, the Trans Mountain expansion. This was supposed to be Alberta's golden ticket. It opened on May 1, 2024, at a truly staggering cost of 53 billion Canadian dollars. It nearly tripled capacity to 890,000 barrels per day, moving oil from Edmonton all the way to the coast of British Columbia. But here's the fatal flaw the market sees right now. If Alberta actually secedes, this massive pipeline suddenly crosses quote-unquote foreign territory. And Independence Alberta would be 100% dependent on the regulatory goodwill of the exact same federal government it just angrily divorced. And the sources highlight exactly why that is an absolute nightmare. Canada's oil is effectively landlocked. Production happens smack in the middle of the continent. Even with TMEP fully operational, S&P Global estimates they need another 900,000 barrels a day of pipeline optimization just to keep up with production growth. But private capital, they are terrified. Who is going to invest billions into a new pipeline corridor if the province might secede and trigger a chaotic, protracted asset split battle with the federal Chrome Corporation that owns the existing pipes? Nobody. Which brings us perfectly to Section 4, the regulatory and legal firewall. Because this push for independence, it isn't happening in a vacuum. It is actively creating administrative chaos right now, well before a vote even takes place. The provincial government, led by Premier Danielle Smith, passed this thing called the Sovereignty Within a United Canada Act. Basically, it allows Alberta to just refuse to enforce federal laws it thinks are harmful. And they've invoked it to fight Ottawa's mandate that oil and gas producers cut emissions to 35% below 2019 levels. Alberta says, no way. That violates our constitutional rights over our natural resources. The result? This massive black cloud of regulatory uncertainty. Alberta claims Ottawa's policies have cost an estimated $500 billion with a B in lost global investment. Oil corporations are stuck in a total no-win scenario. Follow federal law and anger the province, or follow the province, which is telling them to hide emissions data as proprietary and risk federal criminal penalties. What a mess. But you know what the most fascinating, totally non-obvious roadblock to this whole separatist movement is? It isn't Ottawa at all. It's the First Nations. The Sturgeon Lake Cree and other Indigenous groups have launched a massive court challenge. Their argument? Their treaties, like Treaty 8, were signed with the British Crown way before Alberta even existed. So, Alberta has literally no legal right to take their territory out of Canada. Think about that. If the First Nations stay in Canada, an independent Alberta becomes this landless Swiss cheese state without contiguous control over the very ground where the oil is extracted. Institutional sentiment and the pension gamble. Let's shift gears slightly to an angle that is absolutely vital if you're looking at institutional wealth management, because this crisis goes way beyond heavy crude. Get this. The Alberta government is proposing to pull out of the incredibly stable, globally respected Canada Pension Plan, claiming they are owed $334 billion of the National Fund's assets. They want to create their own Alberta Pension Plan, arguing it could lower contribution rates from 9.5% down to maybe 8.2%. Sounds great on paper, right? But institutional analysts are calling this a massive demographic gamble. Economic models show that if positive migration to Alberta stops, which is highly likely if secession triggers economic chaos, nearly 2/3 of that pension advantage just goes poof. It vanishes overnight. It's a huge risk, and 80% of local businesses are expressing serious concern over the province's finances. Furthermore, this supposedly internal Canadian dispute is spilling right across the border. There's this very real undercurrent in the Stay Free Alberta movement pushing for alignment with the United States. We're seeing reports of talks between separatist activists and members of the former Trump administration, really stoking this whole 51st state rhetoric. And look, regardless of where you sit politically, from a pure market analysis standpoint, this rhetoric introduces a highly unpredictable variable into the future of the U.S.-Canada energy relationship.
Section 5. Strategic implications for investors. Let's bring this all together. What does this mean for your global energy portfolio, and how do we actually action this intelligence?
Here are your core takeaways. First up, spread volatility. Do not expect that WCS to WTI discount to snap back purely on pipeline physics. You need to model in a permanent $2 to $5 separatist premium for as long as this referendum is on the table. Second, infrastructure. The TME is an engineering marvel, but it's a political shackle. If a secession vote looks likely, expect the market to heavily discount the value of federally owned pipelines passing through BC by roughly 20 to 30%. Third, regulatory fog. You've got to factor in rising administrative and legal costs for any company caught in the crossfire of conflicting federal and provincial laws in the oil sands. And finally, keep a very close eye on the First Nations legal challenge. Right now, it is the absolute strongest firewall against secession.
Which leaves us with this final, vital question to reconsider your North American risk models. If the Alberta factor triggers on the ballot in October 2026, what happens when billions of dollars in oil barrels belong to a phantom state that doesn't legally exist yet, traversing land it doesn't own, trying to reach markets it can't independently access? Keep your eyes on the Middle East, absolutely. But whatever you do, do not ignore the massive geopolitical risk brewing right now in the Canadian oil patch. Thank you so much for joining me for this explainer. Keep learning, keep questioning, and I'll see you next time.